Dear accountants, I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 13, Statement of Cash Flows from Financial and Managerial Accounting, 16th edition. By the end of this chapter, you should be able to describe the cash flow activities reported on the Statement of Cash Flows, prepare the cash flows from or used for operating activities section of the statement of cash flows using the indirect method, prepare the cash flows from or used for investing activities section of the statement of cash flows, prepare the cash flows from or use for financing activities section of the statement of cash flows. We'll learn how to prepare a statement of cash flows. We'll describe and illustrate the use of free cash flow in evaluating a company's cash flow. And in Appendix 1, we'll use a spreadsheet to prepare the statement of cash flows using the indirect method. And in Appendix 2, prepare a statement of cash flows using the direct method. So before we jump in, let's say you received $100. Right? Ultimately, depending on why this $100 was received, it would make a difference. So let's say it was your birthday or you graduated and someone gave you that $100, it would be considered a gift. Or let's say you were tight on funds and maybe you needed to pay for something and you borrowed $100 from someone. Then in such case, it will be considered a loan. Or maybe you have a job and you completed the job for the week and someone paid you $100. So in all of those different cases, we see that the $100 that was received, it could be associated with different types of events. And these different reasons for which you received $100, the graduation, the gift, borrowing money from a friend or a family member, or money that you've earned from your job, in such cases, they have different implications for your future, right? You would much rather somebody just give you the $100 versus you borrow it for someone and then you need to pay it back. The $100 you get from working, you got to give Uncle Sam a cut when you got to pay your taxes, right? So ultimately, what we're learning in this chapter, company stakeholders, the shareholders, they view the inflows and the outflows of cash differently depending on their source. So what we're going to learn in this chapter, this is ultimately going to help the shareholders, the owners of a corporation, as well as investors. They are ultimately going to use this information to determine the cash flows of the company. So the statement of cash flows reports a company's cash inflows, money coming in, and outflows for the period, money going out. The statement of cash flows provides useful information about a company's ability to do the following: generate cash from operations, because imagine if a company, they have a lot of revenue on the books, however, a lot of the money, the revenue that's coming in, it's on account, right? There's no guarantee that the customer is going to pay for that product or that service. So as an investor, I might say, hey, yeah, the company has a lot of revenue, but they don't have a lot of cash flow. So something to consider. Cash flows also helps to determine how they maintain and how they expand their operating capacity. Can the corporation meet their financial obligations, and can they pay dividends? So these are some key things to consider. So the statement of cash flows reports three types of cash flow activities as follows. So we have cash flows from, meaning that there was positive, and used for means that, used up, essentially meaning that there is a negative. Let's think of it that way. Flows from positive, used for negative. So use from or from and use for operating activities are the cash flows from transactions that affect the net income of the company. So within the normal course of operations for the business, we have cash flows from or used for investing activities. And these are the cash flows from transactions that affect investments in the non-current assets of the company. So as we know, current assets, they're going to be used up, consumed within a 12-month period. Non-current assets are for a period that extends 12 months. Cash flows from or used for financing activities. These are the cash flows from transactions that affect the debt and the equity of the company. So debt represents bonds, equity represents stocks. So the cash flows are reported on the statement of cash flows as follows. So again, it's broken out. Here we see cash flows used for or from operating activities, cash flows from or used for investing activities, cash flows from or used for financing activities. And then we, net all three. That helps us to determine overall, was there a net increase or decrease in cash? We factor in the cash at the beginning of the period. And then from there, that lets us know what the cash at the end of the period should be. So the ending cash on a statement of cash flows should equal the cash reported on a company's balance sheet at the end of the year. So this is also a very useful tool to catch fraud, right? To determine if somebody has sticky fingers and money is being stole from the company. Because after we factor in all of the operating, investing, financing activities and compare it to the cash at the beginning of the period, if the cash at the end of the period doesn't tie, then it's very likely that something is going on. So here with this exhibit 1, it shows us some sources and uses of cash. So what are some reasons why money is coming in, right? As we mentioned, inflows represent money coming in, and outflows represents money going out. So for operating purposes, some of the cash inflows is from selling a product or from providing a service, because as mentioned, operating activities are those within the normal course of operations. Cash outflows for operating purchases. Remember, if we are selling products, in order to make money, you have to spend money. So an outflow would be purchasing inventory. We need employees, so paying them, paying taxes. These are, again, a part of the normal course of operations. Now, as it relates to investing, these, as mentioned, is for the non-current assets. So some examples of inflows for investing would be the sale of property, plant, and equipment, or the sale of investments. As it relates to outflows for investing, this would be the purchasing of property, plant, equipment, and purchasing investments. And then lastly, for financing, as mentioned, this relates to the debt and the equity of a corporation. So some inflows would be issuing long-term liabilities, so issuing bonds to bondholders or issuing stock to stockholders. Financing, some cash outflows would essentially be when we pay dividends to shareholders, when we repurchase common stock, which is referred to as treasury stock, or when we repay long-term liabilities, paying interest, things of that nature. So these essentially are the 3 categories in which cash flows are being broken down. So cash flows used from operating, cash flows from, or used for operating activities. These report the cash inflows and outflows from a company's day-to-day operations, as mentioned. So companies, they could select one of 2 alternative methods for reporting cash flows from operating activities on the statement of cash flow. So they can choose the direct method, or they can choose the indirect method. So keep in mind, both methods, they result in the same amount of cash flows from operating activities. However, they differ in the way in which they report cash flows from the operating activities. So here we see with the direct method reports operating cash inflows, receipts, and cash outflows, payments, as follows. So we determine what's our cash received from customers, cash paid for merchandise, cash paid for operating expenses, interest, income taxes, and from there, we determine what the net cash flows from or used for operating activities. The primary advantage of this method is that it directly reports cash receipts and cash payments for each operating activity on a statement of cash flows. The issue, though, the biggest disadvantage is that this data is not always readily available in the accounting records. So that's something to definitely keep in mind. Not always available. So generally, the direct method is normally more costly to prepare, and as a result, it's not used as often in the practice. Here we see the indirect method. This is, most so used within the profession. So the indirect method reports cash flows from operating activities. It begins with net income, and it adjusts for revenues and expenses that do not involve the receipt or payment of cash as follows. So we start off with our net income, and then we make necessary adjustments. So sometimes there are some expenses that have nothing to do with cash. So this would be like depreciation, right? Depreciation, you initially paid $1,000, let's say, for a 4-year asset. And every year you're claiming an expense of $250. But the reality is the cash outflow actually happened in year 1. We are just allocating the cost. We're spreading the cost over 4 years. So yes, we're claiming a $250 expense, but that expense is not cash related. So we add back certain things, that are non-cash payments, and we subtract things that are non-cash revenue, essentially. So here we see the primary advantage of the indirect method is that it reconciles the differences between net income and net cash flow from operations. So this is essentially an exhibit, cash flows from operations, direct and indirect methods for net solutions. So again, with the direct method, we break it down: cash received from customers, cash paid for expenses into creditors. We get our bottom line, net cash flows from operating activities. Versus the indirect method, we start with our net income and we make the necessary adjustments for any non-cash adjustments. So increase in accounts payable. Why is this a positive? So if we think about it, if there was an increase in our accounts payable, what that simply means is that instead of paying cash for items, we decided to preserve our cash and we incurred a liability. So that is why this $400 is being added versus we have an increase in supplies. So if we have an increase in supplies, in such case, we paid for the supplies. Therefore, our cash balance has decreased because we paid for something. So two different methods, however, they yield the same result. So next we move on to cash flows from investing activities. So we have cash flows from used for investing activities. And again, this shows the inflows and outflows related to changes in a company's long-term assets. And we know assets are anything of value or anything that the company owns that is going to provide the company with value in the future. So cash flows from or used for investing activities, they're reported on the statement of cash flows as follows. So one thing we're going to realize is for operating activities, we can use the direct or the indirect method. Investing and financing activities, they use the same method throughout. There's no difference in reporting. So cash flows from or used for investing activities, we start off with cash inflows, and then cash used for. And then we net the two, and that lets us know if we have net cash flows from or net cash flows used for investing activities. Cash flows from financing activities. This shows the cash inflows and outflows related to changes in the company's long-term liabilities and the stockholders' equity. So cash flows from or used for financing activities, they're reported as follows. We start off with the cash inflows from financing activities. We factor in the cash flows used for financing activities. And then when we net the two, that is how we determine if we have a positive, which represents net cash flows from, or a negative, which represents net cash flows used for. So a company can enter into transactions that involves investing and financing activities that do not directly affect cash. So a company, maybe they'll issue common stock to retire long-term debt. So in such case, there was really no exchange of cash. And although this transaction doesn't directly affect cash, it does eliminate future cash payments for interest and for paying the bonds when they mature. So because these transactions, they indirectly affect cash flows, they're reported in a separate section of the statement of cash flows. The format of statement of cash flows. So the statement of cash flows presents the cash flows generated from, as we know, these three activities: operating, investing, and financing. They are always reported in the same order. So definitely want to keep that in mind. So here we have this example here, this depiction of Rundell Incorporated. They have the statement of cash flows for the year ended 20-year-8. So here we see we start off with operating activities, then we move on to investing activities, and we finish up with financing activities. We determine the net overall increase or decrease in cash. We consider the cash at the beginning of the period. We add the net increase or decrease in cash to the cash at the beginning of the period. And this leads us to our cash at the end of the period, which should tie to cash reported on our balance sheet. And then from there, as mentioned in the previous slide, we factor in any non-cash investing and financing activities. So here we see something called no cash flow per share. So cash flow per share is sometimes reported in the financial press. And as reported, cash flow per share, it's normally computed as net cash flows from operating activities divided by the number of common shares outstanding. But the issue is sometimes this reporting, it can be a little misleading. Why? because essentially sometimes users, they can misinterpret the cash flow per share as the per share amount available for dividends. Sometimes users can misinterpret the cash flow per share as equivalent to or better than earnings per share. So for these reasons, the financial statements, including the statement of cash flows, they should not report cash flows per share. And there are some other ways in which individuals can determine what is the earnings per share, right? Or what is the best way to determine the cash flow of the company. But again, the cash flow per share sometimes is reported, but the issue again is that sometimes it can be a misleading, so therefore not ultimately reliable or should be dependent on to make a decision but solely. So we move on to learning objective 2, where we take a deeper dive into operating activities and how we actually report it based on the indirect method. So the indirect method of reporting cash flows from or used for operating activities uses the logic that a change in any balance sheet account, including cash, can be analyzed in terms of changes in other balance sheet accounts. And by analyzing changes in non-cash balance sheet accounts, any change in the cash account can be indirectly determined. So to illustrate, the accounting equation can be solved for cash as follows. So we know the basic fundamental accounting equation is assets equals liabilities plus stockholders' equity. So we break it out a little further. Cash plus our non-cash assets equals liabilities plus stockholders' equity. So we rearrange the formula. Cash equals liabilities plus stockholders' equity minus our non-cash added. So therefore, any change in the cash account can be determined by analyzing changes in our liability, stockholders' equity, and non-cash asset accounts. So some change in cash can be determined based on change in liabilities, change in stockholders' equity, minus any change in non-cash assets. So here we have this example, same company, Rundell Incorporated. We see the income statement. There's sales of $1,180,000. After we subtract cost of goods sold, there's gross profit of $390,000. And then from there, we see some things going on with our operating expenses. We see there's depreciation expense, but again, we know, this is a non-cash expense. We also have some other operating expenses. We have gain on the sale of land, some interest expense. So after we add and subtract everything that needs to be factored in, that leaves Rundell Incorporated with net income of $108,000. So now when we look at this comparative balance sheet, we see that in 20 year 7, there was cash of $26,000. In 20 year 8, cash is now $97,500. So we should be able to determine why there was a $71,500 increase in cash, right? And again, with the indirect method, we consider any changes in liabilities and stockholders' equity minus any non-cash assets, any changes to those non-cash assets. That ultimately will help us to determine why there was this increase of $71,500. So here we see Rundell's net income for 20 year 8. Again, it was $108,000. And since net income is close to retained earnings, net income also helps explain the change in returned earnings during the year. So the retained earnings count for Rundell as follows. We just have this quick depiction. It starts off with a balance of $202,300. Dividends were declared, $14,000. And then December 31st, there was net income of $108,000. And then on December 31st, they paid dividends again. So there were some increases due to net income and some decreases to retained earnings due to dividends being declared. So the net income of $108,000 that was reported by Rundell Inc., it does not equal the net cash flows from operating activities for the period. Why? Again, this is because net income is determined using the accrual method of accounting. So the key difference between the cash method of accounting and the accrual method of accounting is that with the cash method of accounting, revenue is only recorded when the cash is received. Expenses are only recorded when they are paid under the cash method of accounting. But again, that's not always how things happen in real life. Maybe sometimes there are customers that pay you in advance. So before the customer even receives the service or receives the product, they paid you in advance. So this would be like a magazine subscription, right? In such case, you're paying in advance, you're paying the entire thing, but the company did not actually earn it, right? So that's an example of a prepaid expense from the perspective of the customer, and from the perspective of the company, it's unearned revenue. So these are some things to keep in mind. So with the accrual method of accounting, again, revenues and expenses, they're recorded at different times from when the cash is received or paid. It can happen before or it can happen after. So with the statement of cash flows, it basically helps, to kind of merge, to bridge the gap between the accrual method of accounting and the cash method of accounting. And under the indirect method, adjustments to net income must be made to determine cash flow from operating activities. So here we see this example, some things that increase and some things that decrease. So we start off again with the indirect method. We start off with net income or loss. We make adjustments to net income, to net cash flows. So depreciation of fixed assets. Then we have step 2, we consider any losses or gains. In step 3, we factor in any changes in current operating assets and liabilities. So we have to factor in the adjustments. So step 1, as we see here, we need to factor in expenses that do not affect cash. So some expenses that do not affect cash, they decrease net income, right? So again, a key thing as mentioned was depreciation. That's a really popular one, right? So with depreciation, it decreases net income, but there was no cash payment. So depreciation of fixed assets and amortization of intangible assets, in such case, they are always added back to net income. Step 2 factors in losses on the disposal of assets. They are added, and gains on the disposal of assets are deducted. So the disposal, the sale of assets, is an investing activity rather than an operating activity. However, those losses and gains, they're reported as part of net income. So therefore, to adjust the net income to a cash basis, any losses on the disposal of assets, they're actually going to be added back to the net income. And likewise, any gains on the disposal of assets, they're going to be deducted from net income. So for example, let's say that there was a land, it cost 100,000, but it was sold for 90,000. The $10,000 loss is going to be added back to net income. Why? Because if we think about logic, if there's a loss, the loss is ultimately going to decrease the net income. But again, losses on the sale of assets, losses and gains, they are an investing activity rather than an operating activity. So we factor those in. And then we have step 3. Any changes in current operating assets and liabilities, they are added or deducted as follows. So increases in non-cash current operating assets are deducted. Decreases in non-cash current operating assets are added. Increases in current operating liabilities are added, and any decreases in current operating liabilities are deducted. So this might not make any sense right now. So we're going to look at an example to hopefully bring everything full circle. So as we mentioned, indirect method, we always start off with a net income. We add back depreciation. In this case, there was no amortization, so we just add back the depreciation, which is a non-cash expense. Next, we factor in the gain on the sale of land. Why? Because again, the disposal, the sale of assets is an investing activity rather than an operating activity. So losses are going to be added back and gains are going to be subtracted. In such case, there was a gain, so we subtract it. And from there, we move on to step 3, where we factor in the changes in current operating assets and liabilities. So in such case, there was an increase to our accounts receivable. So in accounts receivable, as we know, this is basically where we provide a service to a customer or sell a product and they give us an IOU, right? They basically say, hey, I'll pay you later. In such case, yeah, our revenue increased, but did we receive the money? No. So if there's an increase in accounts receivable, that means that we provided a service, sold the product, and the customer did not pay us right away. There was no exchange of cash. So based on that logic, we subtract it. Next, we see that there was a decrease in inventories. What does inventory represent? Inventory represents items that we purchased with the intent to resell it. So in such case, if there was a decrease in our inventory, this probably means more than likely that we sold it. Obviously, sometimes there's spoilage and things of that nature, but for the most part, there's a decrease in inventory when we sell it. So because of that, when we sold the product, we received ultimately, cash. And if there was an increase to accounts receivable, don't worry, because hey, that was already factored in, as we see in this first step. Then we see a decrease in accounts payable. Again, everything with accounting is logic. So now let's think logically. Accounts payable represents liabilities, it represents obligations to customers and to vendors. And in this case, if there's a decrease to our liability, logically speaking, that would mean that we paid toward our liability. So a decrease in accounts payable would represent a decrease in cash. Next, we have increase in accrued expenses payable. So accrued expenses, that basically represents expenses that were incurred, however, they were not paid. So in such case, the company, they preserved their cash, or they basically just didn't pay it. They have an outstanding obligation to pay. So therefore, that would be added back 2,200. And then we have a decrease in income taxes payable. So therefore, we paid off a portion of our income taxes, our liability. So therefore, that is a decrease. So as we move on to step 3, again, a lot of it is logic, and I trust everything is going to come full circle. So once we go through steps 1, 2, and 3, we get to our net cash flows from operating activities, which is positive. That is why it says net cash flows from. But if it were negative, in such case, it would say net cash flows used for operating activities. So now we move on to investing. As we know, the cash flows from used for investing activities, this reports cash inflows and outflows related to changes in the company's long-term assets. So similar to preparing the cash flows from or used for operating activities section, each change in long-term assets is going to be analyzed for its impact on cash flows from the investing activities. So here we have land. We see there was a decrease in land. So the beginning balance on January 1st was 125,000. And then as of October 12th, the balance is 80,000. So we started off with 125,000. Now the balance is only 80,000. So we see that there was a $45,000 decline. So the June 8th transaction is the sale of land with a cost of 60,000 for 72,000. So in such case, the land cost us 60, we sold it for 72. In such case, there was ultimately a gain. So the 72,000 proceeds from the sale, they're going to be reported in the investing activities section as follows. So it'll have the description, cash received from the sale of land for 72,000. And then on October 12th, we see that there was a transaction for the purchase of land for cash of 15,000. So in such case, the transaction is going to be reported as an outflow. Money was spent. And it will have the description of cash received from the sale of land, negative 15,000, because again, it is an outflow. Cash is being paid. Next, we move on to the building account of Rundell. So we see that the balance increased by 60,000. January 1st, the balance was 200,000, and on December 27th, there was a purchase for cash of $60,000. And then we also factor in the accumulated depreciation. So we see the building account, the depreciation increased by 7,000. So the beginning balance was 58,300. We claimed depreciation for the year of 20-year 8. So therefore, there was an increase to our depreciation of $7,000. So the purchase of a building for cash is going to be reported as follows. Again, purchase, paid. That basically means cash was impacted negatively. We have less money. So it would be reported on the statement of cash flows as follows. Cash paid for purchase of building, negative 60,000. And this brings us to financing activities. As we know, this section reports inflows and outflows related to the changes in the company's long-term liabilities, their debt, and their stockholders' equity. And again, each change is going to be analyzed so that way we can determine what is the impact of cash flows. So the bonds payable account for Rundell, it decreased by 50,000. So here we see the beginning balance. January 1st was 150,000. And then as of June 1st, they retired by payment of cash at face value. So the decrease would be reported as follows with a description: cash paid to retire bonds payable, because again, paid and purchase we know is going to represent a decrease. So this decrease is from retiring the bonds by a cash payment for their face amount. The cash outflow is reported in the financing activities section as follows. Next, we have common stock. As we know, this represents equity. The common stock account for Rundell, it increased by 8,000. January 1st, there was a balance of 16,000. And November 1st, 4,000 shares were issued for cash. So the balance increased by 8,000 to 24,000. And then we also factor in the paid-in capital in excess of par. In the event that, let's say, the par value of stock is $4, but they sold it for $6, there's additional paid-in capital of $2 per share that was issued. And it will be reported as follows: cash received from the sale of common stock, $48,000. Next, we have dividends and dividends payable. The retained earnings account of Rundell indicates that there were cash dividends of $28,000 in total. How do we know that? We paid $14,000 twice, $14,000 on June 30th and then $14,000 on December 31st. However, as we see here, the following dividends payable account indirect, or indicates rather, that only 24,000 of the dividends were paid during the year. So based on that, we see that the payment, there was a cash paid on June 10th, 10,000 in dividends, and then the June 30th dividends that were declared, they were paid on July 10th. So when it comes to dividends being declared, there are essentially 3 dates. The first date is the date of declaration. This is where the corporation formally authorizes that, hey, we are going to pay dividends to our shareholders, because as we know, with common shareholders, there's no guarantee that they are going to receive dividends. That only applies to preferred shareholders. And for the preferred shareholders, that also, you have to factor in, is it cumulative or is it non-cumulative? So in such case, the first date is the date of declaration. Again, the corporation, the board of directors, they formally authorize, hey, we are going to pay our shareholders, and they create a journal entry. They set up a liability. It is recorded on the books. It is black and white. The second date is the date of record. On this date, this is where the corporation determines, hey, of our, currently 300 shareholders, based on the date that we determine we are going to pay dividends, only 250 of these shareholders are, qualified to get the dividend from whatever, sometimes maybe there's a cutoff period or whatever it is. So the date of the record, that is where they determine who is going to be receiving dividends. And in such case, there is no journal entry. It's basically something that is internally done by the corporation. The key thing is just determining who's going to get the money. The last date to consider is the payment date. So just because they declared it on June 30th doesn't mean that they're also paying it on June 30th. So the reason why there's a difference between the dividends payable in the cash dividends account is because the December 31st dividends of 14,000 that was declared is probably not going to be paid until January of next year. So here we see cash dividends paid during the year. They can also be computed by adjusting the dividends declared during the year for the change in the dividend payable account as follows. So dividends declared from retained earnings. And then from there, we factor in, was there a decrease in dividends payable, or was there an increase in dividends payable? So in such case, that helps to determine what was the total cash dividends paid. So the cash dividends paid by Rundell is 24,000. How do we determine that? The dividends declared was a total of 28,000. There was an increase in dividends payable. So there's an increase in our obligation to pay dividends to shareholders, which means we preserved cash. So in such case, because the dividend payments are financing activities, the cash dividends paid of 24,000 is going to be reported in the financing section with the description: cash paid for dividends, $24,000. So again, this really just all ties back to really understanding the nature of accounting. As I often mention, accounting is not just about numbers. You can be the greatest mathematician in the world. However, if you do not understand the logic of accounting principles, then you're going to find yourself struggling. So logically speaking, if my obligation, my liability increases, and even if we think about it in our everyday life, right? Many of you may have credit cards. So with your credit card, in the event that you're using it all month, you're basically preserving your cash. So when you get your next monthly statement, your liability, your new balance is going to be higher than it was in the prior period. Same logic here. There was an increase in dividends payable, an increase in an obligation because cash payments were not being made. So now we move on from the theory to actually understanding how we prepare the statement of cash flows. The following statement of cash flows indicated that cash increased during the year, and the most significant increase in net cash flows was from operating activities. The most significant use of cash was for financing activities, and the ending cash balance is also reported on December 31st, 20-year 8 balance sheet. So here we're working with the same company, Rundell Inc. And here we see they started off with the 108,000. We had depreciation that we added back, the gain on the sale of land that is going to be subtracted. Why? Because again, the gain on the sale of assets, the disposal of sale, those need to be reported in the investing section. So here we see there's an increase in accounts receivable. Then we have the breakdown of cash flows from investing activities are used for. So this is essentially a breakdown of the indirect method. So we looked at it individually, and now we look at it comprehensively, holistically, starting from the net income to, hey, what is our cash balance at the end of the year? And again, this is a great tool to determine if there was any fraud that took place during the year. So now we move on to learning objective 6, and we look at what's called free cash flow. So with free cash flow, this essentially measures the operating cash flow available to a company after they purchase any property, plant, and equipment necessary to maintain their current operations. So since the investments in property, plant, and equipment is going to be necessary to maintain current operations, it cannot be determined from financial statements. So analysts, what they do is they estimate this amount using the cash used to purchase property, plant, and equipment as shown in the statement of cash flows. So free cash flows is computed as follows. We start off with the net cash flows from operating activities. We factor in the cash used to purchase any property, plant, and equipment, and that ultimately determines the free cash flow. So with this free cash flow, it can be expressed as a percentage of sales in order to provide a measure that can be compared over time or to other companies. Because imagine if you are comparing, apples to grapes or apples to oranges, there are some nuances. So in such case, a ratio or a percentage rather helps again to provide it easier so it can be used for comparison, and the ratio is computed as follows. It's the free cash flow divided by sales. Positive free cash flow obviously is going to be considered favorable. Negative free cash flow is going to be considered unfavorable. So a company that has free cash flow, they're able to fund growth and acquisitions. They are able to retire debt, purchase treasury stock, and pay dividends. A company with no free cash flow, maybe they have limited financial flexibility, potentially leading to liquidity problems. So the reason why free cash flow is important is because think of it from the perspective rather of an investor. Why would I invest my money into this corporation and they're in trouble? That means that I just want to intentionally get a loss. I mean, things change. Obviously, businesses, they have different years. Some years are good, some years aren't bad. But again, just like in a relationship, if you see red flags now before you're married, what do you think is going to happen when you get married, right? So something to really keep in mind. These are why, as we are looking at these analysis for decision making, because that's ultimately the purpose of the financial statements. The financial statements are used by those internally, management, as well as those externally, investors, lending institutions. They use the financial statements to make decisions. So here we have some information from the annual reports of National Beverage Corporation for 3 years as follows. We have year 1, year 2, year 3. So in this case, we are essentially looking at the free cash flow. In year 1, we see the free cash flow was 100,252. Year 2, the free cash flow was 122,747,000. And in year 3, we see that the free cash flow was $101,109. All right. So based on that, again, we are factoring in the net cash flows from operating activities and the cash used to purchase property, plant, and equipment. So we can see that there's a number of things that's happening here. We see that the sales from years 1, 2, and 3 were increasing, but we see that the free cash flow increased from year 1 to year 2. However, it decreased in year 3. So the numbers we see ultimately have an impact. And understanding what the numbers mean, that puts you in a better position to make an informed decision. Now, here we see information from the annual reports of National Beverage Corporation. And again, we saw a free cash flow increase in year 1, or in year 2 rather, but decrease in year 3. The ratio of free cash flow to sales is as follows. So in year 1, it was 12.1%, year 2, 12.6%, and then in year 3, 10.0%. So there's 2 different ways in which the free cash flow can essentially be expressed. So one key thing to keep in mind is that the decreases we saw, it's due mainly to the large increase in expenditures for property, plant, and equipment, and that led to a relatively lower free cash flow. So now we move on to Appendix 1, the statement of cash flows, the indirect method. So with programs like QuickBooks and other accounting softwares, you're tracking your accounting in the software. So essentially, once you need to just pull the statement of cash flows, all of the information is there. They can put the statement of cash flows together. However, certain companies, they still do things manually. For larger corporations, I can't, fathom a really large corporation doing a statement of cash flows manually. But, maybe smaller companies, it makes more sense to do it manually. So there is a way in which you can use a spreadsheet, the worksheet, to prepare the statement of cash flows using the indirect method. So a spreadsheet worksheet can be used in preparing the statement of cash flows. The data for Rundell Inc. is going to be used as the basis for illustrating the spreadsheet we see here. So when using a spreadsheet, there's 7 steps as we see here. We start off with listing the title of each balance sheet account. We're going to list the balance from the balance sheet columns, and whenever there's a credit, we are going to put it in a parentheses. We're going to add the column totals, which should be 0. And from there, we're going to analyze the change during the year in each non-cash account in order to determine, hey, was there a net increase or was there a net decrease? And from there, we'll classify the change as affecting cash flows from the operating, investing, financing, or the non-cash investing and financing activities. Move on to step 5. We'll indicate the effect of the change on cash flows by making entries in the transactions column. And after all of the non-cash accounts have been analyzed, we enter the net increase, or maybe there was a net decrease in cash during the period. And then the last thing we do is we add the debit and we add the credit transaction columns. And after doing that, the totals should be equal. And if they are not, something was probably done wrong. So here we have this example, step 1. This is where we list all of the accounts. Step 2, this is where we list all of the balances. Step 3, again, because total debits and credits tie, the debits are entered with a positive, credits are entered with a negative. So therefore, this should tie to 0. We do the same thing for the balance, the beginning and the end of the year. And then steps 4 to 7, this is ultimately where we come to determine, what are the increases, the decreases overall. And then from there, we analyze the accounts. So by analyzing the non-cash accounts, we'll try to determine the type of cash flow. Is it operating? Is it based on the normal course of operations? Is it investing? Is it based on, non-current assets? Or is it financing? Is this having an impact on the debt or the equity of the corporation that led to the change? And as each non-cash account is being analyzed, there's an entry that's going to be made on the worksheet for the type of cash flow activity that ultimately caused the change. And after all of the non-cash accounts have been analyzed, there's going to be an entry that's made for the increase or the decrease in cash during the period. The entries that's made on the spreadsheet, keep in mind, they're not posted to the ledger. They're only used to prepare and summarize the data on the spreadsheet. So again, spreadsheets are helpful, but for a really large company, definitely not efficient, but definitely can be used. So we move on to retained earnings. As we know, retained earnings represents the net income, net losses, as well as any net income, net losses over the period, as well as any payments of dividends over the life of the company. So the worksheet shows that a retained earnings balance increased during the year. And this increases from the following: net income and declaring cash dividends. So in order to identify cash flows from these activities, there's two entries that are made on the spreadsheet. We have operating activities of net income and then a credit to retained earnings. So the preceding entry accounts for the net income portion of the change, and it also identifies the cash flow in the bottom portion of the spreadsheet, which lets us know, hey, there was an increase to our net income, and it ultimately was because of our operating activities. The dividends amount reported, as we know, is a financing activity. This relates to our stockholders' equity. So in such case, this has a decreasing effect to retained earnings. Why? Because we're paying money out of our earnings to our shareholders. So we debit retained earnings, and then we would credit financing activities, declared cash dividends. So this entry accounts for the dividends portion of the change to retained earnings, and it also identifies the cash flow in the bottom portion of the spreadsheet as it is related to the financing activities. So these are just some journal entries that are essentially made. The entries for the other non-cash accounts are made in the spreadsheet. And again, it ultimately depends on what is happening. So you can feel free to take the time to go through, the spreadsheet and get a better understanding of the journal entries that were prepared. But the key thing, all of this ties right back to the fundamentals of accounting. So after all the balance sheet accounts are analyzed and the entries are made on the spreadsheet, the worksheet, all of the operating, investing, and financing activities, they are identified in the bottom portion of the spreadsheet. And the accuracy, making sure that everything was done correctly, it's verified by totaling the debit and credit transactions, and the totals of the columns should be equal. If they are not, something was done incorrectly, and you would need to go back, work backwards to figure it out and rectify that issue. The statement of cash flows is prepared from the worksheet, and the data from the three sections of the statement are going to be obtained from the bottom portion of the spreadsheet. So this is the work before you actually do the work, pretty much using the spreadsheet. So now we move on to Appendix 2. As mentioned, the direct method is not often used in the industry. However, some people still do use it. The biggest issue, the biggest disadvantage, as we mentioned earlier, is that it's not always available. That's the biggest issue. But it can still be used. So the direct method reports cash flows from operating activities as follows. So we have cash received from customers, cash payment for merchandise, cash payment for operating expenses, cash payments for interest, cash payment for income taxes. So the cash flows from or used for investing activities and cash flows from or used for financing activities, sections of the statement of cash flows is exactly the same. So whether we use the direct method or use the indirect method, investing section and the financing section are exactly the same. And the amount of net cash flows from operating activities, it's also the same, but the key thing between the direct and the indirect method is that they're not reported in the same manner. And under the direct method, the income statement is adjusted to cash flows from operating activities. So here we start off with sales. Cash flows from used for operating activities. This represents cash received from customers. Cost of goods sold, that represents cash payments for merchandise. Depreciation expense is not going to be applicable. Other operating expenses, how much did we pay for our operating expenses? The gain or loss on the sale of land isn't going to be applicable. Interest expense, how much cash did we pay for interest? How much cash did we pay for income taxes? So this just kind of helps to provide an explanation of the key differences between the two. Depreciation does not affect cash, so it's not even considered in a direct method. Gains, losses on the sale of property, plant, and equipment, they are reporting as a part of investing activity. So the key difference between the two is that with the indirect method, we start off with net income, and net income includes any income. It also includes expenses. It also includes gains or losses. Hence why when using the indirect method, we factor in depreciation, gains, and losses. So for Rundell, it lets us know that there were sales of $1,180,000. So to determine the cash received from customers, that $1 million is adjusted for any increase or decrease to accounts receivable, because as mentioned, just because we had sales does not mean that the customers paid us right away. So we need to account for that. So we start off with sales of $1,180,000. However, there was an increase in our accounts receivable. We extended credit to our customers. So therefore, the actual amount of cash received from customers was $1,171,000, because again, the increase of $9,000 in accounts receivable, that indicates that sales on account exceeded the cash received from customers. So sales reported on the income statement. From there, we add any decreases in accounts receivable and we subtract any increases in accounts receivable, and this represents the cash received from customers. Next, we factor in cash payment for merchandises. So the income statement for Rundell reports cost of goods sold of $790,000. But again, just because we have cost of goods sold, we purchase inventory, it doesn't necessarily mean that we paid our vendors. So in order to determine the cash payments for merchandise, the $790,000 is going to be adjusted for any increases or decreases in inventory and accounts payable as follows. So we have our cost of goods sold, our expense, but then there was a decrease in inventory. We sold inventory. And there was a decrease in accounts payable, which essentially represents the fact that we paid, a portion of our accounts payable. So the actual cash payment for merchandise is $785,200. So the $8,000 decrease in inventory indicates that merchandise sold exceeded the cost of the merchandise purchase. And the $3,200 decrease in accounts payable indicates that cash payments for merchandise were more than the purchases on account during 20-year 8. So again, all of this basically goes back to logic. Now we move on to cash payments for operating expenses. So the income statement for Rundell Incorporated reports total operating expenses of $203,000, but this includes depreciation expense of $7,000. As we mentioned, depreciation expense, it is not a cash outflow. So therefore, it's going to be omitted. It will not be included for cash payments. So therefore, it will need to be subtracted. So in this case, the following cash payments are $193,800, computed as follows. Operating expenses other than depreciation, we don't factor in that $7,000. And we factor in the increase in accrued expenses payable. That ultimately lets us determine our cash payments for operating expenses. The increase in accrued expense payable, that indicates that cash payments for the operating expenses were $2,200 less than the amount reported for operating expenses, because again, we held on to the cash we did not pay, which is why we have accrued expenses. So next we move on to the gain on land. The income statement for Rundell reports a gain of $12,000. So remember, we had that land that we purchased for $60,000 and then we sold it for $72,000. So the sale of land is an investing activity. So the proceeds from the sale, which includes the gain, they're going to be reported as part of the cash flows from investing activities. Our interest expense, on the income statement from Rundell, it reports interest expense of $8,000. And in order to determine the cash payment for interest, the interest expense is going to be adjusted for any increases or decreases in the interest payable. So again, all of these things just tie back to logic. Cash payment for income taxes. The income statement for Rundell is going to report income tax expense of $83,000. And in order to determine the cash payments, we factor in, hey, we have what's reported for income taxes. Was there any decrease in our income tax payable? In this case, there was, which simply means that, let's say we owed $1,000. Now we owe only 500. Why? Again, we're going back to logic. We originally owed 1,000. Now we only owe 500. The amount didn't just decrease by osmosis. It means that we paid $500. And once we paid, we know that that has an impact on the cash outflow. So reporting cash flows from or used for operating activities with the direct method. On the next page, we have essentially a depiction of the statement of cash flows for Rundell using the direct method. So as we know, the portions of the statement for the indirect method is going to look a little different, because the indirect method and the direct method, as we mentioned, that is the key difference. The bottom line number is the same, but the method for which it is reported, or the manner in which it is reported, is a little different. So here we see under the direct method, we start off with the cash received from the customers, cash payments, so everything is broken down. And then ultimately, we get to that bottom line of cash balance. So remember, whether we use the direct method or the indirect method, investing and financing stays exactly the same. But we see the difference here for the operating activities section. Now, if we essentially look to the indirect method, we get to the same thing, but the issue is that obviously we are starting off with net income. So the indirect method is generally what's most used in the profession, because the direct method is more time consuming. The information isn't always readily available. But the key thing to keep in mind is that the corporation is tracking the cash inflows, the money coming in and the money going out, based on the three separate activities: operating, which is based on the day-to-day operations of the company. Then we have our investing activities, and these investing activities, these essentially represent any money that is coming in or going out related to the changes in a company's long-term assets. And lastly, the financing activities, which shows the cash inflows and outflows related to the changes in the company's long-term liabilities, their debt, and their stockholders' equity. So this brings us to the end of chapter 13, statement of cash flows. So now that this lesson has ended, you should have learned how to describe the cash flow activities reported on the statement of cash flows. As mentioned, we have the three sections that are always in this order: operating, based on day-to-day operations; investing, based on long-term assets; and financing, based on the company's long-term liabilities, their debt, and their equity. We also had the opportunity to prepare a statement of cash flows. The indirect method is what is most often used. We also described and illustrated the use of free cash flow in evaluating a company's cash flow. In Appendix 1, we learned how using a spreadsheet is essentially, setting the proper, or the final step rather, to prepare the statement of cash flows. And lastly, we prepared the statement of cash flows for the same company, Rundell Inc., and showed the differences between using the indirect and the direct method. And again, as mentioned, whether you use the indirect method of statement of cash flows or the direct, investing and financing activities will be exactly the same. It is only the operating activities section that will be reported a little different. The bottom line is the same, but the manner in which it is reported is a little different. So again, that brings us to the end of chapter 13, statement of cash flows.